Welcome to my presentation on clothing retailing in the UK prepared for the 7045 SSL Business Analytics and Intelligence module. My name is Nilesh Kumar, and in this analysis, I'll examine how key UK fashion retailers Next PCL, Primark, Burberry Group, JD Sports Fashion, and ASOS perform across various financial indicators. I'll highlight patterns in the profitability, efficiency, liquidity, and solvency to understand what drives success and stability in the UK retail sector. The presentation begins with a brief overview of UK clothing retail industry, followed by company profile. Then I'll explain the business metric and visual analysis of revenue, profit, liquidity, and ROCE that stand for return of capital employed. After that, I'll present the predictive analysis result, that is correlation and regression, before concluding with managerial decision-making implications, key analytics focus, and the final recommendations. The UK clothing retail industry is one of the most competitive in Europe, valued at around £46 billion in 2024. It includes both luxury brands like Burberry and value-focused retail such as Primark. The market shows a clear shift towards hybrid and omni-channels model, combine online and physical retail. Sustainability and digital innovation have become crucial, with the companies adapting to charging consumers' preferences and economic pressures such as inflation and shifting demand. So this is the company's overview in which I'm going to explain the five companies analyzed represent different segments of the market. Next PCL is a mature retailer with strong multi-channel operations where Primark focused on affordable high-volume fashion. Burberry operates in a luxury segment with a global presence where JD Sports specialized in sportswear and youth fashion showing rapid growth while ASOS is purely online retailer targeting younger consumers. This diversity allows for rich comparison of strategies, business model, and financial outcome. The analysis uses several key indicators. The independent variable is, of course, profit before tax, and the dependent variable are turnover, gearing percent, long-term liability, liquidity ratio, ROCE, and gross margin. These metric measures financial performance from multiple perspectives, profitability, efficiency, solvency, and operational strength, helping to identify which factor most influence overall company performance and stability. This chart tracks annual revenue from 2015 to 2024. JD Sports shows uh, JD Sports shows most impressive growth, exceeding around £10 million by 2024, reflecting its strong market expansion. NEXT and Primark maintained stable growth with minor pandemic related dips, while ASOS fluctuates due to online competition. Burberry remains steady because of its luxury niche. The trend reveals that hybrid and sportswear retailers outperform purely digital or luxury brand in revenue growth. If we talk about the visualization gross margin by company, the pie chart shows that Burberry leads with a gross margin of nearly 70%, consistent with its luxury pricing strategy. JD Sports and ASOS followed with around 47 to 48%, while NEXT maintains a moderate 37%. Primark, operating a low-cost model, records only 18.9%. This comparison highlights how product positioning and pricing strategy directly impact profit margin across the market. This is the visualization where revenue by company. Here we see total revenue comparisons. JD Sports tops the chart at about £55 million, showcasing its global sportswear success, NEXT ranked second with 45 million pounds, uh, benefiting from its online store, and Primark follows at 35 million pounds, driven by affordability and physical store reach. It contrasts Burberry and ASOS, both generate around 28 million pounds, reflecting their niche focuses. The data reinforces the idea that hybrid retail model achieves stronger revenue outcomes. This is the visualization where liquidity ratio by company. The pie chart highlights liquidity differences. Burberry leads with 1.80, including strong short-term solvency, and EXT follows at 1.40, reflecting efficient working capital management, where JD Sports has moderate liquidity at 0.70, while ASOS and Primark are much lower at 0.50 and 0.11, respectively. This suggests luxury and established brand are better positioning to meet short-term obligation, whereas value and online retailers face higher financial risk. This is the visualization where profit by company from 2015 to 2024, NEXT consistently leads profitability, reaches about 10 million pounds in 2024, and JD Sports followed with over 8 million pounds. Showing steady improvement, Burberry maintains stable profit, while Primark record lower but consistent returns. ASOS, however, become unstable post 2020, moving from profit to loss, likely due to high cost and market saturation. The data shows that diversified and established retail perform more reliable than value or digital-only competitors. This is the visualization of ROCE, that stands for return on capital employed by company. The return on capital employed shows how efficiently company use capital to generate profit. NEXT TCL leads with 39.71%, followed by Primark at 27.4. JD Sports and Burberry perform moderately around 20%, while ASOS lags behind at 7.62%. This indicates that companies with balanced cost structures and diversified portfolio achieve higher capital efficiency and profitability. This is a statistical summary. The statistical measure shows variability in performance. The mean ROCE is 23.06%, with the standard deviation of 19.57, suggesting difference in capital use across the firm. Gross margin average is 44.11%, reflective stability profitability in the sector. These figures confirm that efficiency in capital management, not just scale volume, drives financial success, and that some firms consistently outperform other due to strong operational discipline. This slide states predictive analysis, that is correlation. The correlation matrix reveals key relationship. Return on capital employed is The return on capital employed is positively correlated with gross margin and liquidity ratio, meaning that efficient capital use enhance profitability and solvency. Meanwhile, the negative correlation between ROCE and long-term liability, that is minus 0.48, suggests that excessive debt reduces efficiently. Overall, strong ties exist between profit indicators, while leverage shows an inverse impact on performance. This slide shows the regression model explain about 60% of variance, that is 0.5999, in company performance. ROCE is equal to 0.001 and liquidity ratio is 0.03, are significant positive predictors of profitability, while gross margin shows a slight negative effect, that is 0.005. The result confirm that efficient capital and liquidity measurement are the main drivers of profit, enhancing the importance of financial decision making for retailing front. The managerial decision making, the key managerial impacts includes improving capital efficiency, maintaining optimal liquidity, and managing debt responsibility as well. The key analytics shows that the difference in ROCE and liquidity, such as Next PCL 39.71 and Burberry 1.80, understand how capital use and solvency shape performance. Positive assets turnover links reveal the strategic investment in asset drivers growth. So in conclusion, UK clothing retailers' success depend on effective capital utilization, liquidity control, and debt optimization. Next and JD Sports leads due to balanced model and strong financial management, while ASOS and Primark face solvency risk. I recommend optimization leverage and enhancing liquidity and investing in digital and asset efficiency. Continuous monitoring of profitability and market trends will help sustain growth and competitiveness. And in the last, these are the references that I have used and all the data that I have collected from. So thank you and have a nice day.